Hello everyone, this is Teddy Keckstedt from Forex Trading Unlocked, and we are here today with a Forex market live analysis on Wednesday, March 3rd, 2021. Let's pull up our disclaimer here, and just wanted to remind you that this webinar is for illustrative and educational purposes only. And then we also want to remind you to check out the book High Probable Japanese Candlestick Patterns. It's available on Amazon.com in Kindle and also in paperback versions. We would also like to remind you to subscribe to our Twitch channel as well, Forex Trading Unlocked, or our YouTube channel, Forex Trading Unlocked, whichever is the medium that you are choosing to use to view our videos, especially our live webinars as they occur. So, and now with that, let us get on to what you are here for. All right, we have the forex-trading-unlocked.com website pulled up, and from your nav bar, if you go to the Market Analysis and Education tab, you pull up the Workstation page, and you can use all the little things that are on this page. A chart being one of them that's just totally functional in live real time that you can use for all the Forex markets and a lot of markets around the world. The only thing that's in delay is the futures because of regulations, because the only way you can have futures data in real time is if you are paying for it. It cannot be broadcasted live. There's always a delay. So dollar index came back a little bit yesterday. Today, it's a little bit of a mixed bag of goods. So right now, the market, or the index, no matter what, is coming off of a higher move low, and we are trying to figure out whether or not it's going to break out to the upside, which right now, it looks like there are a lot of things that are pulling at the dollar in both ways, but I think it's what's pulling at the other currencies that's going to really dictate movement. Now, the dollar index, even if the dollar is strong versus most currencies, is going to have a lot of trouble being very strong in its movement in either up or down ways because of the various things that are pulling at the markets right now. So let's look at the Euro US dollar. All right, Euro US dollar right now, what is it doing? It's chopping around over the past few days. It established a higher move low off of a lower move high recently. So what does that mean? It means we have a lot of indecision here. The market's kind of wedging. As far as the euro, we have a lot of factors that are negative for the euro. High oil prices right now, the 30-year Treasury bond, which is tanking, and there's a couple other things that are weighing on this market as well. So we did have a sell signal right here a couple days ago. This is a bearish engulfing line. Now, as far as where this goes, if this is right now a bullish buildup happening here where we're basing and getting ready for another rally, which is really big should we do so, then you should expect trading to kind of consolidate a little bit more today and definitely not fall below this $19.91. A failure from here would confirm a newer move low on the hourly and the daily basis, which would also have us leaning on this $19.51. Any failure from here is very, very negative for the euro. Now, not that it's going to fall apart and get down to $1.10, but for the euro to get down to about $1.18 to $1.17 half area is very, very possible should we fall below $19.51. Now, there are certain things that are helping to put stress on the euro. One of them is the 30-year Treasury bond futures. Now, they are in the middle of rollover, which means that the June contract is now becoming the front month as far as volume as the March comes off the board over the next 2 weeks. I would be hard-pressed to see the dollar get any severe break in the index, especially, or overall with the dollar against most currencies, while this 30-year Treasury bond is hovering on its lows. The Treasury bond market would need to have a probably upwards of 5 to 7 basis handle move that would get it back above this $168 level in order for the dollar to be a very big bear. So that's one of the things you need to watch out for. We have other things that are impacting, such as oil and a bunch of other things that are hurting the euro. as well as the fact that since post-Brexit, now the UK is not helping to bail out these European countries. And with tensions in Syria rising, that means you're going to have more refugee issues in the EU, of which has to be supported by Germany across all those countries and flip the bill for that. And that does not bode well for the euro. So right now we're looking at a kind of a choppy trade. This short-term sell signal, if this was just a corrective move, already hit the target just a little bit through it yesterday. So now if this is a sell signal that's on a longer term wave, meaning that we're going to fall below $1.1951, well, that's a totally different story. In that case, I would say that like I said, we're going to look for a test of around this $1.18 to $1.17 half area. All right, now let's look at the British pound US dollar. Now the euro is the biggest GBP USD. The euro is the biggest component of the dollar index. It being lower today is helping to give the dollar index a little breather off of yesterday's sell-off, and the pound now is slightly higher today, so that's kind of canceling out the downward nature of the euro. Is this a pause for the cause when it comes to the British pound US dollar? Now this thing is a raging bull versus the dollar. It has been for months. I would be very mindful of this sell signal here. This is a short-term sell signal. This is a bullish engulfing line, high probable Japanese candlestick pattern that has reached its short-term target yesterday. A longer-term target for this one, we'll just give you a fib example. If you read the book High Probable Japanese Candlestick Patterns, you can find out how we actually find out most of our targets and stuff like that. So as you can see, the 0.618 level is here, and the 0.5 level is there. So we already hit the 50% through the 50% yesterday, right in the middle of the zone. If this is just a short-term correction before we make another run for new highs, then this is probably where you're going to see the market bounce out, trend off of now higher. Okay, so this is kind of a key little thing going on. If we come back and take out this low here from yesterday, that would be a very negative sign that the British pound US dollar wants to press this correction. Now, use caution on this. This is a counter trend trading signal, which a lot of times we would not really worry too much about. However, since we have such strong forces guiding the currencies right now, such as oil. Now, oil being high as it is right now, it had fallen back for a couple days. It's already today, let's see, on the CME site, crude oil right now is up over $1. Remember, we have inventory numbers right now. Inventories have been growing in the midst of railing oil and gas prices. That's typically not very common, but that means that's how forward-thinking the market is, especially because we're looking for supply issues to start to shrink in the United States due to cutbacks in production. So now the fact that the rest of the world doesn't have these issues is huge for the British pound, because oil definitely helps to keep the British pound higher. The higher up price of oil is, the stronger the British pound is globally against most currencies. This is something that is a commodity-driven variable. The fact that the interest rates are tanking, that should be putting pressure on the pound, but the oil factor is just too strong in this trade. So the long-term trend is bullish. We did not take this sell signal just because it's not because it's a counter trend trade, but whenever you have extenuating variables that really are helping to promote this trend, like for instance, if there would have been a sell-off in oil besides that 2-day little knockoff that just happened, then we would probably be jumping on this signal. Like for instance, if oil was already off, like say $3-4 a barrel off, a barrel off of its high, we might have jumped into it. But when the oil was making new highs and looking like it still wanted to continue to make highs, it's really hard to take a trade like that. So always be careful when you're using a counter. Like if you always want to trade with the trend. So in other words, like right now we would be looking for a good buying opportunity, because the monthly, the daily, the weekly, the hourly, whatever you want to put it on, is basically a bull. And then you add the oil trade factor into it. As long as that's in play, that's another reason to look for a buying opportunity and not try and fade this momentum of this bull, because it is just too fears. At least that's the proper way to manage it as far as I view it. So as far as looking for a signal and actuating it, this one we didn't mark it because there's too many extenuating variables that keep us from wanting to be a bear right now. So as you can see, the bounce off of the low isn't that strong. It would not surprise me for us to take out this low and come back around this this like $39.06 area. Even if we fall through here, I think it's going to be consolidating, especially if oil stays strong before it gets another wave higher. Remember, we have divergence in the currencies. So the dollar index could be a bull against most currencies. Right now, the ones that are driven by oil are going to be lagging in that regard. And if anything, they may be going counter trend. And as we move through these currencies, we're going to show you how this diversification is impacting. Look at the US dollar Swiss. The US dollar is strong versus one of the flight to quality currencies. Remember, Swiss, yen, and dollar are the three flight to quality currencies. Since the Swiss is now lower versus the dollar and trending lower, and since we have the 30-year futures that are tanking the way it is, and since we have oil that's also rallying, see, since we do produce oil, even though we are no longer going to be an exporter because of the new Biden executive orders, we still produce oil. So we are not, even though we will become oil dependent again, we are not totally dependent on it, whereas in Switzerland, they are completely dependent on it. So the higher price of oil hurts their currency, the higher price of our Treasury bond hurts their currency, and then the fact that the euro and the Swiss have to work on holding up the European Union, that hurts the currency. So that's why the dollar, when you have a flight to quality currency falling against another flight to quality, that just starts to show you how strong the US dollar truly is. So where it is weak, versus the pound and stuff like that, that's because of those extenuating market moves in the commodity markets. And if you think that inflation has only started to peek its head and is on an uptick, we're at just the beginning, folks. I don't care where you are in the world. If you think that inflation is not going to go skyrocketing over the next 1 to 4 years, you really better start to look at things, because everything from policies to recovering from lockdowns, let's just say we truly come out of the coronavirus pandemic thing in a positive way over the next 6 to 12 months and continue to do so and leave it in our wake, that's still not going to stop the inflation trade. There are variables and powers that be that wish this to happen, and guess what? It is happening. So, and that is going to impact the currencies in a big way, and also as the currency valuations change, that is going to also cause tons of inflation globally, so which is going to impact our global equity markets and will continue to drive the bond markets higher. See, this is where you have, normally you have flight to quality in bad times, the bond market should be going up. It's going down because the market doesn't care about what all the pundits are saying anymore. They're saying we are demanding higher market rates. You know what happens when the 30-year bond commands higher rates? The price of oil and other commodities go up because the cost of carry goes up. When the cost of carry goes up, then that means the currencies are in play. So this trend right now with the US dollar Swiss, we are now looking to challenge a multi-month high here at 92.08. Sorry about that. Should have had that phone off. We forgot to remove that one earlier today. Sorry. So we'll have to cover this one up. Sorry for that ringtone. Okay. That's a little bit better. Okay. So once again, the US dollar Swiss continues to rally. And we believe this trend is going to maintain this kind of momentum. Now, as far as the steepness of the slope, I think we're due for a little pullback, similar to what we had in February. It will last about a week or so, but right now, let's see if we challenge this 92.08 level. I would say that after the oil numbers come out today, that most likely you're going to see maybe not necessarily a build, but I don't think much of a shrinkage in supply. Unless there's a major shrinkage in supply, I think that you will continue to see the US dollar Swiss hover along below its highs, maybe have like a little pause like it did here last week before it pierces this 92.08. How high can this go? Well, let's look at the weekly. See now, right now we are still in an upside correction in a bearish trend. okay? But we've started to round out this bottom here, and definitely taking out this area here at 92.08. That is a big area for us to get above, because that would confirm a higher move high after a lower move low, which neutralizes this bearish trend right off the bat. So we haven't neutralized this trend right now. It's still in a corrective phase as far as confirmation wise goes, and any rally above 92.94 changes everything for this market. Anything above there confirms the fact that this market wants to, even if it falls back, set a base and can stay strong at this level. And this may become the floor. Like we may have planted right here a couple weeks ago. This low right here, right around what is it, 87.5. This may be the low in the U.S. dollar Swiss for not just the next couple weeks. It could be for the next couple of months. It may even be for the rest of the year. So especially as oil prices continue to rise, which I've been just calling for $100 oil ever since January, actually Christmas time, when we knew that the transition of power was going to go to Biden. So especially because of the executive orders that were put in place on the first day of inauguration and all the actions that have gone on since. So I would say, unless somebody changes his mind on his stance on oil and the new Green New Deal, which I don't think is going to happen, this is what's going to go on. This trend is now in place. These factors you cannot change. These are the things you can't change, so you're going to trade accordingly, I would hope. So now let's go and see how this is impacting the rest of the world. So US dollar, Japanese yen is also getting hit really hard because of the oil market. As you can see on a weekly basis, this has had a big move in 2021. This is for multiple reasons. One is oil. The fact that oil has been rallying. Well, Japan doesn't produce oil. They're oil dependent completely. So this is huge. The fact that this is something that Biden and the news media doesn't like to tell you, that since the United States no longer is a net exporter of oil, this hurts our ally Japan, because guess who we export oil to? Japan. So now Japan now becomes oil reliant on carriers that have to come from other places that are not as good for the environment. Also, it reduces your number of producers, which means you the less, competition helps to keep prices down. That's why inflation has been held at bay for years, because of global competition and even competition within microcosms within the microeconomies. Because of the fact that now we are restricting trade, restricting competition. When you limit competition, that causes inflation, which causes obviously prices to rise. In countries like Japan, that does not help them very much at all. So the only thing this helps us, as far as for the United States, is that it gives us the ability to buy Japanese goods at a cheaper rate. So as our economies may slow and what have you, and even if inflation kicks in because of dollar strength versus Japan, that means buying Japanese goods will not be so bad. So in that regards, it may help them, but the thing is they're not getting as much for their goods. So that means they're reaching the point of diminishing returns, and they're getting squeezed as far as gaining any equity. So it's got a really double negative when it comes out to the realities of what's happening with this move. Now, how high can this go? We made a higher move high today. I would not jump in front of this freight train, folks. And just because of the variables that I put out for you today, I think you need to look for a reason to buy this market. Like look for corrections like this and have a nice little, I would say, every bit of $1.50 move. Like for instance, if we came back from, we're right around 107 even, if we fall back to 106 to 105 half area, somewhere around here, I would look for a buy signal then. This trend right now is in play. This is a complete revolving of trends when it comes to certain currencies. Like I said, the oil and interest rate markets are driving this. Here's another thing that's driving this one, and you're going to really like this one. So we're going to go over here. Look at this, the gold market. The gold market has been in a bearish trend in a big way. This is an upside down chart of the US dollar yen right now, from the beginning of the year to right now. As gold continues to tank, this also hits the Japanese currency, the Japanese yen. Why is that? Well, because gold reserves are something that definitely is important to sovereign nations. Because Japan is a big holder of gold reserves. As gold tanks, as oil prices go up, as interest rates in the 30-year bond go up, that means that you have bearish pressure on the Japanese yen. So, and here's something you want to take a look at. If you don't think that the yen, look at the British pound JPY. Same thing. The British pound JPY, it's very strong. Look at the Euro JPY. This is strong too against it. Okay, it hasn't made a higher move high, but it is still trending strong, and we know that the euro is showing signs of weakness. CHF JPY. Now this one you wouldn't normally look at. This is kind of interesting. Flight to quality. Remember we were talking about the dollar is overtaking the Swiss. It's also overtaking the yen, but the yen is actually stronger versus the Swiss right now. Probably because the Japanese yen is not going to be drained by multiple other countries like the Swiss is. Now let's look at the AUD versus the JPY. All right, remember the oil-driven trade that I was talking about? Why would Australian dollar be stronger than the yen of all things? Well, the main reason is the price of oil. So if you want to see where strength, remember that I always say that the best indicator for a market is other markets. And to look at this one, this is the way I see it, is that you have this weakness that's developing because of these commodity-driven trades, and you can either follow these things or you can ignore them. To ignore them right now is rather obtuse, and you just have to see, you can see right here, we are showing you the strength and the weakness. US dollar, JPY, the currencies that are strong versus the dollar because of oil are the same ones that are strong versus the yen, because yen, the Japanese, are very dependent on oil. So that's why this surge, I would say, is not going to stop. Look to buy dips as far as upside targets. We're looking at 107.5 to 108.5 now as far as longer term targets. As far as when do we think we're going to reach it, probably rationally would be over the next like 4 to 6 weeks. But the way this trend is accelerating right now, it may be even sooner. So we're not going to try and pick a top here, never try and do something like that. Trade with the trend, wait for a buy signal. All right, back to the Australian dollar, US dollar. This one had a bearish engulfing line sell signal. Just like the British pound, it is hard to take a counter trend trade when this has got so many variables like the oil trade keeping it up. So I would key off of this 80-12 area. Anything above here, definitely do not be short. That's not a good idea. If you're an aggressive seller, this is your risk level right here. You do not want to be short against this above this level. As far as how far can we go down, well, I think the key is 75.63 is holding up this market. Only if we would get a failure here would I become not bearish, but I would say we're in a very big consolidating range trade, beginnings of a consolidating range trade. The only thing that would change this perspective would be if the interest rates could get a bounce. That's not so much going to impact it as much as oil. If you were to see a big sell-off in oil, then maybe this would happen. But you're talking about seeing oil back down at like $55. So if oil was to take a $5 to $6 break in the market, falling lower, then I would see this correction actually becoming an extended correction. Remember, this has been a raging bull for a year now. So is it going to top? Eventually, yeah, it will. But like I said, these variables that are commodity driven are not going to stop right now. And only if there's a reversal in those commodities in the CRB and especially in oil and the interest rates, I don't see it happening. It's just not going to happen right now. So we'll be monitoring that and watching that. New Zealand dollar, US dollar is very similar to this one. As you can see here, we have a dark cloud cover sell signal that had occurred. We're looking for a challenge of 74.63. All trading below here, you can be an aggressive bear. But like I said, with the oil trade and what have you, I think this, if anything, this is setting up for a big consolidation range trade. We're going to set those parameters. If we fail here at 71.55, well then we'll look to grind down towards the 70 even. I am not looking for a big break here, if anything, because this has been a bull just like the Aussie has been for a year. We're looking for a break to buy. The oil trade is also in play here, so as long as oil is on its highs, we're looking for a snap back, looking for a reason to buy this market. All right, let's look at the US dollar Mexican peso. I have a lot of friends that are going down to Mexico with their kids and stuff for spring break, or even their older kids are going, the college kids are going off. Even though I guess all the colleges canceled spring break, supposedly, there's kids that are going no matter what. Duh. What a surprise. So US dollar Mexican peso has definitely rounded out a bottom, has made higher move highs and higher move lows on the weekly basis, which now is indicative of a nice corrective move to the upside that's turning into a bullish trend. As long as we stay above this 20.34 pesos to the dollar, look for a challenge of 21.05, looking for 21.5 as our upside target. We are looking for another swing high, probably to develop over the next 2 to 3 weeks. This is also encouraging because I wouldn't say it's currency manipulation, but the fact that we have a reason to entice tourism, one thing that would help them would be a falling peso to the dollar. Also, the interest rate mechanism is one of the reasons this is happening. Oil, this is a tough one because Mexico does produce a lot of oil, but here's the one problem with that. Mexico produces a lot of oil, but they've given their rights away to China and to a bunch of other companies in a big way around their borders, especially offshore. So a lot of the drilling and a lot of the oil that comes out of Mexico is not Mexican. They no longer, it's not sovereign oil is what it is. They're not making the money off of it, at least not much, except for leasing fees. So that's something that I think is probably also keeping the US dollar and the Mexican peso in this relationship being bullish to dollar. US dollar Canada, this is another oil traded market that we had a bullish engulfing line buy signal that occurred the other day. And remember, if you want to learn how to trade these high probable Japanese candlestick patterns, check out the book High Probable Japanese Candlestick Patterns on Amazon.com. And you can learn how to trade these signals or incorporate them into your own methodologies and trading systems. So this market here had already hit the short-term high. It has a little bit more to go to the upside, around $1.2820 here for an extended upside target. This is going counter trend. This market has been a bear versus the dollar Canada has been a bull versus the dollar, meaning the US dollar Canada has been a bear for a year now, and especially being compounded and just driven into the ground by this oil trade. That's why I would say wait for a reason to sell this market. Only a turn in oil would have this reversing gears. We have besides the Canadian politics that are going on, which that's a whole nother ball of wax. We don't even want to talk about how they are definitely leaning towards one side and are dominated by forces outside of their country. Then the oil market, that's the biggest force that's dominating them because they are a big oil producer. The one thing that is hurting them, though, is we know that what happened with the XL pipeline that was now kiboshed by President Biden. So that had hurt them a little bit. That's probably why we've rounded out a little bit. This trend is not so severe because oil has definitely rallied. I mean, if you think about it, when we can go look at the pound again. Oil has been rallying for a month, and you can see, boom, it definitely hit the US dollar Canada, but not quite as severe as it did with the pound and stuff because this market's already been just hammering the dollar. So right now we are coming off of a lower move high. So we had a higher move low, or lower move low that set our signal, our buy signal, counter trend trade. We came up and rallied, and we've fallen back over the past couple days. So no matter what, we've established a lower move high. This is still in a bear market. Remember, fundamental technical analysis. Lower move highs, lower move lows is a downtrend. Just like higher move highs and higher move lows is an uptrend. So this is a downtrend. It is still in a downtrend. only a rally above $1.27.5 here would change things, because then that would make a higher move high after a higher move low on the short term, which would then reverse gears and put us in the neutral aspect. Just because if we did make a higher move high above $1.27.5, that could also be perceived as a extended lower move high after a lower move low. So the true key is we have to get above, well, I guess, let's see, if a solid one would be $1.2882. That would definitely confirm us being neutral to possibly even slightly bullish to US dollar Canada. So let's look at the euro, or the British pound, US dollar. This one is quiet. It's not as high on the day as it was before. It's starting to fall back a little bit. Dollar strength is creeping in as we speak. And we have the euro US dollar, which is falling back on its lows. So yes, with what's going on here right now, key off of these oil numbers that are coming out at, was it right just before 9:30 Central Standard Time? So that would be in an hour. And then, by the way, in an hour and 10 minutes, you can actually see me on tfnn.com for our weekly spot at 10:40 Central Time, 10:40 Eastern Time, 9:40 Central Time. Where I will do my spot on tfnn.com and talk to Tom and Tommy O'Brien about the currency markets and what's going on globally in the online trading environment. So before we get off this, we want to take a look at Bitcoin, just to end this on a nice little note here. So we had a bearish engulfing line sell signal a couple weeks ago that touched off this slide. Interestingly enough, the low from a few days ago came just below the 50% line, and now here we are spiking higher. Now the big thing is that we are coming off a higher move high and a higher move low, or a lower move low, because this low had come down and had made a couple of gyrations bouncing up and down. So we fell off this high, made a low, then we made a lower move high, lower move low again. Now the question is, are we starting to make higher move highs? Are we going to make a run for 57,500, or are we coming back towards this lower 40 band? I think that right now, with Bitcoin and the way the other markets are swinging, you have flight to quality going on in the dollar. You don't have it in the bond market. You don't have it in the gold market. Oil is rallying. You're seeing, I think, a lot of profit taking. You had a lot of buying going on between this 40,000 up to 57,000. I think you've seen a lot of profit taking. So a lot of sideways action is probably going to occur. Obviously, if we continue to move higher, then with a bullish trend is intact. It isn't a bull trend. It's only in a short-term corrective phase right now. So I know there's always people that are bearish Bitcoin because they hate it, and there's people who are bullish because they believe it's the future. Who knows what it is? It doesn't matter. It is now a trading market, and right now it is looking to consolidate, I think. So you can key off of this level right here. Now, if we take out this low from a couple of days ago, right here around 43,000, that would be kind of a negative signal and have us leaning back on this 40,000, which I think you would find a good bottom, because this is where it was very toppy before. So somewhere around, if it does fail here at 43.69, I would say you're probably going to see a good helping hand hold supporting the market around 40,000. Does that mean I'm looking for a big bullish bounce from there? Not necessarily. I think if anything, Bitcoin is getting ready to consolidate between 40,000 and 55,000 and stay below its high probably for the next couple of months. I don't look at this like most other markets. I look at it as you can chart it. As far as fundamentals, I mean, gold is crashing, it has been tanking, oil is going up, so the gold trade is off the table with Bitcoin, unless you truly believe that gold has no value anymore and Bitcoin does. However, it doesn't cost any energy to hold gold. However, there is a cost to carry, which is driven by the 30-year bond futures that does give you a cost. And that's probably one of the reasons why gold is tanking, because of the fact that interest rates are going higher, even if the central banks do not do anything about it. And that's what really makes it scary, is that I have never in 30 years seen a move like this. Like, this is on the weekly. let's go to the daily, and this is like shocking. So on the daily basis, if we just look at this year, we topped out here at 170 basis handles and got all the way down to 157. That's a 23 handle move as far as from high to low this year. Well, actually, no, if we go all the way back to the top of this year, it was 173. So 173 down to 157. That's a $25 move in the Treasury bond market without any central bank action anywhere, not even just our own central bank, around the globe. This does not happen in the interest rate market. That is the markets dictating to everyone that interest rates are going higher. It's just going to happen. It's going to help drive inflation, and also it's going to impact all kinds of other markets that will cause ripple effects to impact the currencies. So watch, as we're talking, the euro US dollar is now leaning back towards its lows, and we are looking for this to continue. Dollar bulls are probably going to have a little fun with this, and just watch that oil number in just under an hour, and we'll see how things pan out. So I want to thank you very much for your time today. Please do us a favor and subscribe to our YouTube channel and Twitch channel, Forex Trading Unlocked, if you have not done so. And like our video and pass it on to your Forex trading and other market trading friends. And check out the book, High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And if you want to check out Forex-Trading-Unlocked.com website, there's under our courses and education tab on the nav bar, you can go down and find the tab for High Probable Japanese Candlestick Patterns and do a little reading and checking out the book ahead of time. So with that, I want to thank you very much for joining us on Wednesday, March 3rd for our live Forex trading.